Welcome back. So recently, Morgan Stanley upgraded India's FY25 GDP forecast by 20 basis points to 7%. This is post the high-frequency data for the month of August, which has recorded positive growth in sequential terms after declining for the previous 3 consecutive months. So to talk more about this upgrade to India's economic outlook, we have with us the author of the report, Upasana Chachra, Chief India Economist at Morgan Stanley. Upasana, morning, and thank you for joining in. This is Reema here. So take us through the economic indicators that you've picked up recently, which makes you more bullish. And is this an upgrade only for FY25, or is there an upside risk to FY26 too?
Hi, good morning. So on GDP, what we've done is that we have upgraded our numbers for fiscal 25 by 20 basis points to 7%. This was on the basis of one being higher GDP growth numbers that we saw for the June quarter numbers. So quarter ending June has been a little better, especially if you look at the GVA or the supply side of the growth data points. Despite some headwinds from lower government spending due to the election cycle, as we know, and also the lingering impact of poor weather on agriculture growth. So despite that, GVA growth did surprise our numbers by about 30 basis points, coming in at 6.8, i.e. the supply side of the economy was pretty robust. And if we look at now, the X-forward indicators for growth trajectory, especially in the next 3 quarters, I think if we were to normalize government spending from just the June quarter numbers for what we know from the budget, we will see incrementally or sequentially the fiscal support to be better than the June quarter. And also now there is greater confidence or certainty that the agriculture growth would be better than last year, given that the monsoon season has been pretty decent and crop sowing activity is also picking up. So in that context, we do see some pickup in these, driven by these two segments, and also still sustaining the growth momentum across other drivers. And therefore the upgrade to fiscal 25 numbers. So to your question, yes, this is an upgrade to fiscal 25 right now from 6.8 to 7. For the next 3 quarters, if I have to see, then the upgrade is a little bit more at about 30 basis points versus our earlier trajectory. Currently, we retain fiscal 26 at about 6.5%.
Okay. Upasana, morning. In that case, in the consumption basket itself, which are the major contributors? We've been talking about rural recovering, but do you think it will outpace the urban consumption, or will it remain at par?
So, yes, rural has been definitely a positive and the support factor for consumption growth. And if we look at the overall consumption numbers as well, private consumption surprised positively, I would say, in the June quarter, coming in at 7.4%, a 7-quarter high. And if you look at the previous few quarters, it was pretty dismal at about 4% levels. Rural demand, I think, from the high frequency data, if you were to see, has been showing signs of recovery from, say, the beginning of this year or the March quarter onwards. High frequency demand indicators like two-wheeler sales or FMCG volume growth in rural areas versus urban areas has been picking up since the March quarter. The trend has sustained in June as well. And going forward, I think, especially for fiscal 25, farm incomes should be supported, as we discussed. Weather has been decent and better versus last year. Crop sowing is going to be higher versus last year, and therefore farm incomes should be supported this year versus last year. There's also support from inflation moderating on a YOY basis, like fiscal 25 will likely be around 4.5 in our view versus close to 5.5 last year, and therefore purchasing power does get supported from that trend as well. And I think therefore rural demand would probably continue to outpace urban for a little bit longer, just because these tailwinds are there, and therefore fiscal 25, I think you may continue to see this play out in terms of rural sort of catching up due to the sluggish growth that we've seen in the last 2 years.
Upasana, what explains the drop-off in India's growth rate next year versus this year? Next year, 6.5%, and this year it's 7%, according to your estimate. So why the decline?
So I would say that I wouldn't really characterize this as a decline or a major slowdown. I would say that India's growth on a more medium-term basis would probably be somewhere between 6.5 to 7%, and these are more sustainable levels of growth. So there will be some amount of base effect that will play out in the next year on the agri growth numbers. It could also play out a bit on like the rural demand numbers, just the base effect, and therefore I think that shouldn't really be seen as a major slowdown, but just as coming to a more sustainable level. Now, obviously, there are various growth drivers, and external demand remains a key one where there is still some uncertainty. So, how that plays out will finally influence those fiscal 26 numbers as well. But as of now, I would say that think about it more as a medium-term growth handle where you will see growth more trudging in the 6.5 to 7, which is pretty robust levels.
Upasana, now let's talk about the inflation number because we are getting into the festive season as well. We've been talking about how food inflation is a big part, 45.86% of the overall CPI basket. Considering that we are entering the festive season, what kind of inflation targets do we see? Will we see food prices increasing further because of the kind of environment would be in? And what is your FY25 target here?
So for fiscal 25, our CPI inflation number is at 4.5% YOY on an average basis. For the second half, we are going to be close to that level itself at about 4.5 because there's been a lot of base effect, especially in these recent readings, and we'll probably be seeing, as we saw the July print coming in at 3.5, we'll probably be seeing August also similar at 3.5, but that's mostly driven by base effect. So as the base effect neutralizes, you'll probably settle at around a 4.5 level. Now, if you have to think about the drivers and especially food, as you asked, food inflation has been a problem, especially trailing 12 months. We've seen food inflation spike due to the poor weather impacting, the longer cropping cycle products like cereals and pulses, as well as some of the shorter cropping cycles like vegetables due to demand supply mismatch or unfavorable, bouts of weather. So that has been an issue. But going forward, given that sowing activity is picking up, rice sowing is up, pulses sowing is up quite meaningfully, you will see better crop output, which will start kicking in from the September, October, or the harvest season. And therefore, this cycle of the agriculture season, which starts from this harvest cycle and goes up to the end of the winter cropping cycle as well, I think that's where we will see more improvement in food inflation outlook. So I think the festival season I know is generally characterized by some bouts of pickup in prices, especially vegetable prices. So I think that seasonal trend can continue on the shorter cropping cycle products like vegetables, but more from a 6 to 12 months perspective, I think outlook on food inflation is actually better than worse or improving versus last year.
Quick answer here, Upasana. What's your August CPI inflation print that will be out later this week? Your own expectations, and when should we expect the first rate cut from the RBI?
So August CPI around 3.5, flattish versus July. The base effect is still playing out somewhat, and then you also have sequentially better or trend in the food price basket. So no major change in the August CPI in our view. Going beyond August, we see numbers reverting into the 4.5 range. In terms of first rate cut, so we don't have a rate cut anytime soon in our forecast horizon from the RBI, driven by the fact that growth is pretty robust at 7%. RBI's numbers are higher than ours at 7.2. And also inflation remains above the 4% mark at 4.5. So I think with this construct of where we are seeing growth and actually the drivers of growth remaining pretty robust and indicating a more broad-based growth recovery, I think the focus can sustain on ensuring that inflation aligns to the 4% mark. And therefore, in our view, probably we're not seeing rate cuts that quickly. If we were to go wrong, I think either growth is weaker, probably driven more by the global slowdown, global growth surprising on the downside, or inflation coming more closer to the 4% handle.
All right. Okay, Upasana, thank you so much for joining in today. It was a pleasure speaking with you about a whole host of things, everything macro, of course. We'll speak to you soon again. But with that, we'll slip into a break. When we come back, we'll discuss market technicals with Soni Patnaik of JM Financial Services and also discuss the top trading bets. Stay tuned.